Please welcome Andrew Ross Sorkin and his guest, the chairman and CEO of BlackRock, Larry Fink.
Larry Fink is here, and of course, oversees what is now, I want to say almost about $8 trillion, give or take. There was a period which was about $10 trillion. I want to thank you for being here because you've been on this stage now a whole bunch of times.
Right.
We appreciate spending time with you, in large part because I would argue that you have been a real pioneer on a lot of these issues that we talk about, ESG and the like. And that's why I wanted to have you here, especially this year, because there has been, as you know so very well, a backlash about ESG and the like, and what it means, what capitalism is about, and all of that. And I want to get to that, and I want us to have sort of a bit of a rager of a conversation, if we could, about it. But I want to start, because we had the Treasury Secretary here earlier, just to get your sense, also because you've been right more times than not, about where you think we actually are in the economy right now.
Well, I hope you invited me because you like me too, though. I did not just. Hi, everyone. I think there's many great things going on in the world and the economy. Obviously, it's being hidden in the narrative, and obviously the reality of really elevated inflation. Markets that are down 18% in equities, down pretty close to 18% in bonds, the appreciation of the dollar. So there's a whole reset in the marketplace. And the reality, the U.S. is feeling much less pain than other parts of the world because of the dollar appreciation and other issues. But I actually believe inflation will be abating very rapidly.
Will evade rapidly.
Yeah, I mean, is it going to go back down to 2%, which is their objective? That's going to be hard, and that's going to be the fundamental issue. Where is an acceptable level of inflation? I mean, in my 40-something years of being in markets, you would have dreamed for 3 or 4% inflation. So we set this target now of 2%, which can be debated why too, and I've had conversations on that. My biggest worry is not that we're not going to see a falling of inflation back to 3 or 4%. My biggest worry is the world is losing hope. We have seen a collapse in birth rates and demographics. We're actually going to enter a period of more what I would call malaise. We are all seeing the transformation of China. China going from what I would have called a very economic-minded economy to a more ideological economy. We're seeing the attendant effects on that, and we're seeing a Chinese economy slowing down to a 3. We have the European economy that is really fundamentally changed right now related to the Russian gas and the cost of energy and the fiscal support by governments. And so I believe after we get out of this real spike in inflation, we're going to be waking up to a world that's going to be a 2-ish, 3% world with maybe 3 or 4% inflation. And I think that's going to be the fundamental issue that we're going to be facing. And because of the situation that we saw just 6, 8 weeks ago in the UK, there is a limit on how much fiscal stimulus governments can rationally do without having the marketplace rebel, and that's what happened in the UK. So after we get out of this burst of inflation, it is my fear that we are not going to have the ability for any fiscal stimulus for any time soon. Deficits do matter. And at the same time, the central banks are going to take years in which they're going to have to unwind all their quantitative easing, all their bond purchases that they did over the last 10 years and aggressively in the last few years. They're not going to be as fully equipped to re-stimulate the economy. So we believe we're going to have rates fundamentally higher, maybe where they are today. They're not going to go down. At the same time, we're just not going to have an economy that is based on real growth that we're accustomed to.
So what does that mean for everybody here who has a 401k or money in the stock market?
I would say for long-term investors, this is a great paradigm because...
But if the other side of it is some kind of malaise...
Yeah, but Andrew, if you look at what it took to... Over 50% of our assets are retirement assets. And all I do is focus on how do we get to a long-term outcome. And all my letters are based on that long-term ideal. It is actually easier to meet your long-term liability, which everybody assumes about a 7 or 8% return over 20, 30 years. You're going to have a nice pool of money. It is actually safer to invest to get that return today because you have 2 years trading at a 4.25. You have 10-year credit you could buy, at a 5, 6% return. I actually believe we're going to go from this hyper interest in growth stocks. We're going to have this hyper interest in earning coupon, hyper interest in investing. Secretary Yellen talked about the IRA, which we are very bullish on and what that impact will do. Those types of subsidies that are coming from the government to invest in decarbonization, it's going to produce 12, 13, 14% returns very easily. We've done investments like that already. And so I think it is actually going to be easier to meet your investment targets today than it was a year ago. To meet your investment targets a couple of years ago, you needed to invest heavily in private equity. You had a short liquidity to get to the return. And now you're able to more safely invest in other things that providing you a coupon to get to your return. So despite all the doom and gloom, there is more opportunities to invest in the markets today than it was a year ago.
We talked to the Treasury Secretary about crypto, and as you know very well, we're going to talk later to Sam Bankman-Fried, or so we think. BlackRock had an investment in FTX.
$24 million in a fund of funds.
$24 million.
Yeah, it was not in the core part of our business.
Okay, so what do you think happened there? And then I want to talk about the diligence piece of it, because part of what's happening here is there's a lot of people questioning all of these fancy firms that everybody looks
Right.
at, Sequoia, you, others, a lot of people invested in this company. Mm-hmm. And it appears that nobody was minding the store.
Well, I think people are minding the stores. The question is, we're going to have to wait and see and how this all plays out. I mean, right now we can make all the judgment calls that it looks like there was some misbehaviors of major consequences. I assume, if you look at the Sequoias of the world, they've had unbelievable returns over a long period of time. I am sure they did the due diligence. Could they have been misled? Could they have done other things? Could we have been misled in the small little investments we did? Sure, but until we have more facts, I'm not going to speculate.
Is it fair, though, to think about venture capitalists as self-regulators, if you will, of these types of companies? And the reason, and look, there's, you can look at Theranos and you can look at all sorts of companies, and we don't know what this situation is in front of us right now. But it seems to me that in the venture world, the whole business model is actually not to due diligence. The entire business model is, out of 50 investments, 40 are going to fail, and we know that in advance. So the cost of actually diligencing this all out to perfection may not even be necessary, because what we're really doing is hoping that we hit just a couple of Grand Slam home runs, and that's just fine.
And that worked. It probably is not going to work in the future, because I don't believe we need another food delivery company. I don't believe we need where all this money was going to go. I actually believe where more and more venture capital money is going to be going, and more early investment is going to be fundamentally in decarbonization. It's going to be a different science. It's going to require really underwriting the science behind these entrepreneurs. I'm visiting young entrepreneurs who are trying to do, whether it's sequestration or a better way of improving farming. By encoding seeds that already have the ability to create their own fertilizer, to reduce fertilizer. There are some amazing technologies that are being developed today. So I actually believe we're going to be seeing a transformation of where this money is going to go. It's not going to go to all this stuff that maybe provided us good utility to get food quicker, or find a taxi sooner. But I actually believe it's going to be much more in hard science, and it's going to require a lot more technical understanding.
Has this changed your view of crypto at all? You now have a deal with Coinbase, and yet you were always sort of also, I think, a bit of a skeptic of all of this.
Oh, I actually believe most of the companies are not going to be around. I still believe that. I do believe
Because they're now real, they're frauds, they're what?
Well, I mean, think about FTX. I mean, you could look back now. FTX created it. Its failure was it's creating its own token. It was not a DeFi. It wasn't a ledger that was open to the world. It was a closed ledger.
Right.
It was not distributed. So the whole foundation of what crypto is, it's supposed to be a distributed ledger that is across the system. I actually believe this technology is going to be very important. Look at it. We have been part of a huge revolution in investing through ETFs. We believe that ETFs will be changing the whole way we invest. Many people still use it as a means, people are investing it for indexing. No, the majority of people who are putting money in in ETFs are active investors that are buying exposure. The entire bond market is being transformed as we talk right now. I believe the next generation for markets, the next generation for securities will be tokenization of securities. And if we can have that distributed ledger that we know every beneficial owner, every beneficial seller, we all have our code of who's buying, who's selling, instantaneous settlement. And think about it, it changes the whole ecosystem. You don't need trust banks.
But does that disrupt you eventually? Because you are custodying all of these assets.
No, we're not a custodian. We're not, we use third-party custodians in everything we do.
In everything you do?
We're not a custodian bank.
So your goal, by the way, I don't think that he was technically a custodian either, which is a separate issue.
I think they were. I don't know if there was a real custodian in that closed ledger, but that's a whole other story. You should ask him that question. No, I mean, the transformation, think about it, instantaneous settlement, bonds and stocks. No middlemen. We're going to bring down fees even more dramatically. As for me, I don't have to vote on any shares anymore because the beneficial owner will do all the voting. They'll have it.
And that's where I want to go with this conversation.
Okay, I knew I was going to take you there.
Thank you. So you have been writing letters, and I've been writing about those letters.
You have?
For what now I think is going on more than a dozen years. And you have written some provocative letters about what the purpose of a business is, the social mission of a business is, and the idea of ESG. Mm-hmm. And I would say for the last couple of years, it was actually quite a popular thing. Business Roundtable took on a lot of the mantra of what you were talking about and the like. We saw a lot of investment in clean tech and everything else. And then the pandemic happened, and then this year happened. And when I say this year, I'm thinking about the war with Russia. I'm talking about
energy prices.
The price of energy. And all of a sudden, the conversation switched and changed. And there are now a lot of Republicans around the country who are very unhappy with you. Treasuries of different states who are saying
I actually think some Democrats are unhappy with me too. I think there's some balance there. There's some symmetry.
So, but tell it. But there has been a rebuke, if you will, to what some people call woke capitalism. What do you say to that?
As I wrote in my last letter, I believe stakeholder capitalism is not political. It is not woke, it is capitalism. More than ever before, especially during the pandemic, if you were not focusing your employees and the issues around your employees, you were not doing your job. You asked President Zelensky about Ukraine and about Taiwan and you use a foundation that, and maybe you even asked Secretary Yellen the same question. 1,200 to 1,700 companies left Ukraine. They didn't leave Ukraine because there were sanctions. They didn't leave Ukraine because the CEO woke up and said, gosh, I want to take up an impairment charge. They left Ukraine because their employees, their clients said this is the right thing to do It's not like they wanted to take an impairment charge. To me, that is stakeholder capitalism. You were responding to the needs of your stakeholders, and you're doing it for the beneficial interests of your shareholders. Let's be clear. The shareholders are the primary stakeholder. But to achieve the long-term interests of your shareholders, and that's what I'm focused on, not any short-term thing, but the long-term thing, to create that durable profitability, you have to be focused on all your stakeholders, your clients, your employees.
But here's then the question.
But I want to get to one really important point on this. I mean, so yes, you're right. There's a lot of noise, and it really does fill the airwaves. And so, fills up the time on the airwaves about the attacks from some states, to me specifically, and to the firm. In the first 3 quarters, we raised about $88 billion of net new money in the U.S., more than any other public firm. Most public asset managers have had outflows this year. Over the last year, rolling year, we've had $258 billion of net inflows. So, the reality is the majority, the unheard, unspoken majority, really like what we are doing, what we are saying. I'm not happy with the narrative because it fills the airwaves and we have to spend a lot of time. And let me be clear, I am spending a lot more time in Washington state. I'm trying to correct the narrative because in most cases the narrative is not based on facts. It's based on somebody else's view of the facts.
But let me ask you this. You have talked about climate change being sort of the central issue of our time and the need to confront it. And I think there was a view that you planned and had influence to vote shares on behalf of customers to do that. Interestingly, your most recent letter of this year seems to take a little bit of a step back on that.
If you probably dissected my letters better than anybody. I don't think there's been any changes at all. We've always talked, first of all, we're writing things that we think about are really being impactful for the long term. Unfortunately, the long term is not something that is topical today. And let's be clear, populism is not about long-termism. Populism is about the moment. And let me be clear, one of the greatest reasons why we have inflation is because of populism. We are doing things for the short term. And so many of the things, I mean, I could go on the whole short-termism of populism and what we've done and created this inflation. But I've always spoken about the need for hydrocarbons. I actually believe we're going to need hydrocarbons for 70 years. Okay, but the key, and this is what we're really focusing on, the key is how do we sequester and how do we capture carbon? How do we reduce what we are using and doing? And how do we?
But now you're getting it on both sides. Because I was going to say there are red states that are coming after you on one end, and saying that, right? And now there are
the blue states are saying we're not doing enough. And I would love for all states to focus on the long term. I think we are doing a great job as a fiduciary to every one of our clients by identifying these long-term issues. And I think our flows are showing you that it's still reaching the key.
But you've talked about also trying to get out of actually having that influence. So one of the things you're also doing is effectively trying to let shareholders vote themselves.
So,
but where I want to go with this though is the question is whether actually most shareholders don't actually vote.
Correct.
And so what does that mean?
Well, what we're doing right now, we only have the legal ability to go back to the defined benefit plans, to go back and say, would you like to have that vote? And over 25% of our defined clients that have now moved that they are doing their own vote. I hope, and I wrote this, I truly hope in a letter I wrote 6 weeks ago on where we are with voting choice, I truly hope that they take the responsibility to understand each vote and be a fiduciary to all their school teachers and firemen and all the other people they're doing this for. I can tell you, we've taken a very important step on this. And if society wants to bring back the vote to the individuals, if we could get some law changes that bring back the vote to the individual holders and all that, and we could do that. Will that lead to some outcomes that maybe not be good? Maybe. I mean, if the people who are taking back their vote, whether it's an individual or a corporation or a pension fund, they take back their vote and don't do the necessary research on how to analyze and they rely on the proxy voting organizations, we're in trouble. And if they take back the vote and don't vote, it's a field day for activists because they have more control of the actual vote. It's a field day for foreign investors who do vote. And so let's be clear, we have taken a responsibility in making sure we're doing everything we can for our owners of capital. All the $8+ trillion that we manage, none of it is our money. And so we've taken a really important step. But if society wants to bring not having BlackRock have that power, we are providing an answer.
But what do you say to those who say the whole purpose should be to put as much money in the pensioner's pocket as humanly possible? Many years ago, CalPERS decided they were getting out of investing in cigarettes, nicotine, and they decided they were getting out of investing in guns.
Yes.
And then there was a study done, interestingly, 5 or 8 years later, that said that they lost money, a remarkable amount of money, actually.
They did.
Doing
well, not a lot, because it was a small part of the index, but
billions of dollars, though.
Maybe.
And so the question, therefore, is what's the answer to that?
Well, we have said to everybody, do not divest of hydrocarbons. And in my first letter, second letter, third letter, we are not, because I do not want, and this is where I've had attacks from the far left. The last thing we want is the money to be moved into private hands. So when an organization divests, it's just going to a private hand. It doesn't mean the net zero footprint of the world changes. And so our belief has always been, let's keep it as transparent and public and working together. Let's work on it in the long term. But the outcome of divestiture is not a good outcome.
But then explain this. There was a period of time where I think you had actually pushed Exxon to do some divestitures. And some of those divestitures, no?
No. What we voted, I mean, the ExxonMobil vote, which was very popular in how that came out, let's talk about the facts. For 10 years, ExxonMobil underperformed its peers. And since that vote, they've outperformed their peers. It was about governance. It was not about environmental.
I could talk to you about this for so very long.
But but the story is, if you look at the results from that vote, they've outperformed their peers. It's not because they outperformed because the energy market went up a lot in the last year and a half. You just use their comparison of the other energy companies in the United States over 10 years and where they have been in the last 2 years. And ExxonMobil has finally outperformed.
Final question. I think your letters have influenced boards in ways that are maybe not even fully appreciated or understood, or maybe that it is understood, and maybe for some reason, for some people too much. My question is whether you think it's going to shift, whether you feel the shift happening because of the pushback in all sorts of states, not just on the issues of energy, but voting rights, what happened in Florida with DeSantis and Disney. I mean, all of these sort of social issues, what happens?
I never wanted my letters to be influential. I wanted my letters to be topical. So let's start there. And every letter was meant to be talking about long-term issues because the narrative, the financial narrative every day is about the tick-tock of the market, about meme stocks, about crypto, and none of that really matters. What matters is the long-term outcome, since most of our money is retirement. I write these letters with the idea that it's a 20, 30-year narrative and how to give people hope and confidence. I look at what BlackRock's job is to provide hope. Because if you don't have hope, why on earth would you invest for 20, 30 years outcome? Okay, if you have no hope, you're going to keep all your money in a bank account. And that's what we're seeing in China right now. 45% of all savings is in a bank account. You systematically see an 18% savings rate in Europe because they don't have the same hope that Americans do. I mean, one of the most influential reasons why America differentiated itself over the 50 years post-World War II, now 70, is hope. We have had the ability to have more long-term hope. If we lose that long-term hope because of the narrative and all that stuff, it is going to be harder for the U.S. to have differential growth.
On that note, thank you, Larry Fink.
Thanks, everyone.
Appreciate it. Thank you, everybody.